All right, everybody, welcome back. We are going deep today. We're tackling the banker's new clothes.
Ooh, that's a good one.
It is a good one. And it's a really interesting look at how the banking system, even though it looks all nice and buttoned up,
Right.
might actually be way riskier than a lot of us realize.
Yeah.
So joining me today to help break it all down is a true financial whiz.
Well, I don't know about all that.
You definitely are. You know this stuff inside and out.
Well, I've spent some time with this book. It's a fascinating read.
So before we get too far, just a quick reminder for everyone listening. Our deep dives are all about taking these complex topics and really breaking them down, making them easy to understand.
Yeah, absolutely.
And in the case of The Banker's New Clothes, the authors are Anat, Admati, and Martin Hellwig.
Yeah, and
they really don't hold back.
they don't mince words.
Yeah,
They do not mince words.
very straightforward. So I guess the best place to start is, why are banks so risky in the first place? Like, what is it about the way that they operate, the way that the system is set up, that makes them so vulnerable?
Yeah,
I mean, I think a lot of us, we put our money in the bank, we assume it's safe.
right.
What are we missing?
Well, I think one of the biggest things that Admati and Hellwig really hammer home in this book is this idea of equity. So, we all kind of understand equity if we think about owning a home, right? You put a down payment on a house, that's your equity, right? And if housing prices go up, you have more equity in your house, you feel good.
Right.
But if housing prices go down, you might end up owing more on your mortgage than your house is worth. And that's a bad situation to be in, right?
That's underwater.
You're underwater. That's exactly right.
Yeah.
And banks, they essentially operate in a very similar way. Their equity is kind of like their down payment on all the assets that they hold, all the loans they make. And what Admati and Hellwig are saying is that, banks are operating with really low equity. They're kind of like buying a house with a tiny little down payment.
Oh, interesting. Okay.
And so that makes them really vulnerable to any kind of economic shock. If asset prices go down even a little bit, suddenly their equity can get wiped out and they're in a really precarious position.
So it's like they're super leveraged.
Super leveraged.
Okay.
Exactly.
So how much equity are we talking about here? Like, what's a healthy level of equity for a bank to have?
Well, most people would think, 50%, 60%, that sounds pretty safe, right?
Yeah.
But the reality is banks these days are operating with equity levels that are way, way lower than that. We're talking, maybe 5, maybe 10% in some cases.
Wow.
And so, that means that they're essentially borrowing, 90, 95 cents on the dollar for every dollar that they lend out. And so, that's where the risk really comes in.
Yeah. So if things go well, everybody's happy. But if things start to go south,
Right.
it sounds like the potential for a really big crash is there.
Absolutely. It's like relying heavily on your credit cards. As long as you have a job and everything's good, you can manage that debt.
Right.
But what happens if you lose your job or, you have some unexpected medical expenses? Suddenly that debt becomes a huge problem and it can spiral pretty quickly.
Yeah.
And that's kind of what Admati and Hellwig are worried about with the banking system as a whole.
Okay. So then the question is, why? Why is this allowed to happen?
Right.
Why are banks allowed to operate with such low equity? You would think that there would be regulations in place.
Yeah, I mean, that's kind of the $1,000,000 question, right?
Yeah.
And there are a lot of factors at play here. I think one of the biggest is just the sheer power and influence that the banking industry has. They have armies of lobbyists. They spend a ton of money on political campaigns. And, they've been very successful at convincing policymakers that, look, we need to keep equity levels low so that we can keep lending money, so that we can keep the economy going.
Right. So there's this idea out there that we need banks to be risky to keep the economy going.
Yeah, but what Admati and Hellwig argue is that that's actually not true. That, in fact, higher equity requirements would actually make the system safer and more stable and would allow banks to lend more responsibly over the long term.
Okay. So help me understand that. How would higher equity requirements actually lead to more lending and a stronger economy?
Sure. So think about it this way. Right now, because banks have such low equity, they're very vulnerable to any kind of economic shock. And when those shocks happen, they tend to pull back on lending, right? They get scared.
Yeah.
They want to preserve their capital. And that can actually make the downturn worse.
Right. Makes sense.
But if banks had more equity, if they had more of a cushion, they would be less likely to panic in a crisis. They would be able to continue lending even when things were tough.
Oh.
And that would actually help to stabilize the economy and prevent those really deep, painful recessions.
Okay. So it's kind of counterintuitive. It's like you would think that forcing banks to hold more equity would make them less likely to lend.
Yeah.
But what you're saying is it actually, in the long run, it makes them a more reliable source of lending.
Yeah.
And actually helps to create a more stable economy.
Exactly. It's kind of like the difference between, building a house on a foundation of sand versus building a house on a foundation of solid rock.
Right.
The house on the sand might look fine for a while, but as soon as a storm comes along, it's in trouble.
It's going to fall apart.
Exactly. But the house on the rock, it can weather any storm. And that's what we want for our financial system. We want it to be built on a foundation of strength and stability.
Okay. So that makes sense. But I have to ask, we had a major financial crisis in 2008. We've had all these regulations put in place since then. Dodd-Frank, all this stuff.
Right.
Why haven't these issues been addressed?
Yeah, that's a great question. And Admati and Hellwig actually talk quite a bit about this in the book. And their argument is that, a lot of the reforms that have been put in place since 2008, they've been well-intentioned.
Right.
But they haven't really gone far enough. They haven't really addressed the fundamental problem of low equity.
Okay.
They've kind of tinkered around the edges.
So it's kind of like putting a Band-Aid on a bullet wound.
Exactly. It might stop the bleeding for a little while, but it's not going to fix the underlying problem.
Right.
And they argue that until we address that problem, until we force banks to hold more equity, we're always going to be vulnerable to another crisis.
Okay. So we've talked about equity. We've talked about how, low equity levels make banks risky. We've talked about how that risk can actually spill over and impact the entire economy. Let's talk about solutions for a minute.
Sure.
What do Admati and Hellwig propose as some concrete steps that could be taken to make the system safer?
Yeah, so they actually lay out a pretty clear roadmap in the book. They have 4 main recommendations. And the first one is, as we've been talking about, increasing equity requirements.
Okay.
So they argue that banks should be required to hold at least 20 to 30% equity.
Okay.
Which is a significant increase from where they are now.
Right.
But they argue that it's necessary to make the system truly safe and stable. The second recommendation is to eliminate government subsidies and guarantees to banks.
Okay.
So, right now, banks enjoy all sorts of implicit and explicit guarantees from the government.
Right.
The too big to fail problem, for example.
Right.
And these guarantees, they create what we call moral hazard, right?
Yeah. You mentioned that earlier. So moral hazard, for those who aren't familiar, is basically the idea that if someone knows they're not going to bear the full cost of their actions,
right,
they're more likely to take risks.
Exactly.
So in the case of banks, if they know the government's going to bail them out if they screw up,
right,
they're more likely to engage in risky behavior.
Exactly. And so Admati and Hellwig argue that we need to eliminate these guarantees.
Okay.
We need to make banks responsible for their own actions. And that will force them to be more prudent, to take less risk.
That makes sense.
Yeah.
All right. So increase equity requirements, eliminate government guarantees. What's number 3?
Number 3 is to promote competition in the banking sector. So, one of the problems that we have right now is that we have a very concentrated banking industry.
Right. We've got these mega banks.
Exactly.
These too big to fail institutions.
Yeah, and they dominate the market, and that gives them a lot of power and influence.
Right.
And it also reduces competition, and competition is really important in any industry, right?
Right.
It forces companies to innovate, to offer better products and services to lower prices.
Right. Exactly.
And so Admati and Hellwig argue that we need to promote competition in the banking sector. We need to break up the big banks, encourage the entry of new banks, and create a more level playing field.
Okay. So more players in the game.
Exactly. More players in the game.
All right. And the 4th recommendation.
The 4th recommendation is to simplify the rules and regulations governing the banking system. So, one of the problems that we have right now is that the rules are incredibly complex and convoluted.
It's a mess.
It's a mess. And that actually makes it easier for banks to find loopholes, to find ways to game the system, to take on hidden risks.
Right. So you're saying that the complexity actually kind of works in their favor.
Exactly. It creates this illusion of safety.
Yeah.
Regulators can say, oh, look, we have all these rules in place. But the reality is that the rules are so complex that they're very difficult to enforce. Yeah. And so Admati and Hellwig argue that we need to simplify the rules, make them clear, make them concise, make them enforceable, and that will actually make the system safer.
Okay. So it's kind of like, if you have a really complicated tax code.
Right.
It creates all these opportunities for people to find loopholes and avoid paying taxes that they should be paying.
Exactly. It's the same principle.
Right. Whereas if you have a simple tax code, it's much harder to cheat.
Exactly.
Okay. So we got these 4 recommendations. Increase equity requirements, eliminate government guarantees, promote competition, and simplify the rules. And the argument is that these changes would actually make the banking system safer, more stable, and actually, in the long run, better for the economy as a whole.
Exactly. That's the argument.
Okay, so I think we've covered a lot of ground here. We've talked about the risks inherent in the current banking system. We've talked about why those risks exist, and we've talked about some potential solutions.
Yeah.
But I think the big question that a lot of our listeners are probably asking themselves right now is, okay, so what? Why does this matter to me?
Yeah.
I'm not a banker. I don't work in finance.
Right.
Why should I care about any of this?
Yeah. No, I think that's a totally valid question. And I think the answer is that the stability of the banking system is essential to the stability of the economy as a whole.
Right.
And so even if you don't work in finance, even if you don't have a lot of money in the bank, your livelihood, your job, your retirement savings, all of these things are ultimately dependent on a stable financial system.
Right.
And so when the banking system is at risk, everyone is at risk.
Yeah. I mean, we saw that in 2008. When the financial crisis hit, it wasn't just bankers who lost their jobs. It was people in every sector of the economy.
Exactly. People lost their homes, they lost their businesses, they lost their life savings.
Right.
And so, this is not just an abstract issue. This is something that has very real consequences for everyone.
Yeah. And I think that's one of the things that Admati and Hellwig do really well in the book.
Yeah.
They make it very clear that this is not just about numbers on a spreadsheet.
Right.
This is about people's lives.
Exactly. This is about people's lives. It's about their livelihoods. It's about the future of our economy.
Right. So what can our listeners do? I mean, is there anything that they can do to help push for these changes, to make the system safer?
Yeah, I think there are a few things. I mean, first and foremost, I think it's important to be informed, to educate yourself about these issues.
Okay.
Read the book, read articles, talk to experts, and really understand what's at stake.
Right.
And then once you're informed, you can start to engage in the political process.
Okay.
Contact your elected officials, let them know that this is an issue that you care about.
Right. Support organizations that are working to reform the banking system.
Okay.
And just make your voice heard.
Yeah, make some noise.
Exactly. Make some noise. Because the reality is that, change is not going to happen unless people demand it.
Right, exactly.
Yeah.
Okay, so as we wrap up here, is there one final thought, one kind of takeaway that you would want our listeners to leave with?
Yeah, I think the big takeaway for me is that the banking system is not as safe and stable as we've been led to believe.
Right.
And that we need to be doing more to protect ourselves from another financial crisis.
Okay.
The reforms that have been put in place since 2008, they've helped, but they haven't gone far enough.
Right.
And so we need to keep pushing for more change, for more reform, for a system that is truly safe and stable.
Okay.
Excellent. Well, I think that's a great place to leave it. And I would just encourage all of our listeners to check out The Banker's New Clothes, to really dig into this issue, to start thinking about what kind of financial future we want to create for ourselves, for our families, for our country.
Absolutely.
And remember, understanding these issues gives us the power to demand better.
Yes.
So thanks for joining us for this deep dive, and we'll see you next time.
Thanks for having me.
Of course.